guys, welcome back. We continue with our discussion on the stock exchange. The discussion so far has been quite interesting and the feedback is good. I've noticed that this discussion on the stock exchange is quite confusing for a lot of people. So I'm going to take another shot. I'm going to explain a bit more about the stock exchange, about why I am advocating for saving in the stock exchange. Someone said to me, you are advocating for they actually say there's a difference between saving and investing. I do agree with them, but I also wanted to make it very clear that if you are just putting money aside, if you are putting money under your pillow, in your bed, you are not saving. You are keeping money for transactional purposes. You are keeping money for tomorrow's use, and that is not saving. Once your money is ready to be used tomorrow, you are not saving. Saving is where you put your money aside and you get a return on it. So there's a difference, but it's one and the same thing. Money that is saved should be invested elsewhere and provide you with a return on your capital. So as we talk about the stock exchange, someone came to me and they said, what is the difference between saving in the stock exchange for a short period of time and a long period of time? Why? Because what we have noticed in recent months, especially if you look at the Zimbabwe Stock Exchange, is sometimes it's on a bull run. A bull run is where the stock exchange is growing and the figures are, the prices of shares is going up. And if you buy your shares when there's a bull run and you immediately want to sell them because you want to benefit from the bull run, you're likely to lose out. How? Because when you want to sell them as soon as possible, something that normally happens is called a bear run, where the stock exchange, then the price starts going down. So you find that the graph of the stock exchange is always up, down, but the eventual graph is always going up. So that's the gradient. It's always going up, but in the short term, it may go up. It's volatile. It may go up, down, like that. Now, that's where the difference is between a trader or a speculator and an investor. Now, the problem with most of us Zimbabweans is we are now used to short-term returns. We now want quick back. The Mbinga spirit is upon us, where you want to get quick returns on your money. If you are investing on the stock exchange, normally you must forget about quick return because you will reap in the future. Now, a trader or a speculator is that person who wants to trade in today and go out of the stock market tomorrow. What they are simply doing is they are betting on a certain share to say this is going to go up in the short term. I'll go in and I'll go out and reap my returns. But an investor is someone who's long-term. An investor is someone who's patient. And I'm advocating here for us to be patient with our capital, to be patient with our savings. So like we said the other time, if you are putting your money consistently on the stock exchange, you will realize that you will eventually be getting money. One, you are getting a return on the money that is already there. Two, the money that you're putting in is also giving you a return. So you'll be benefiting both ways. We must try to avoid being traders or being speculators, because when you enter the stock exchange trying to quickly be rich or trying to get quick riches, you are likely to lose out. Why? Because if you enter today, it's a bull run, the stock exchange is going up, and when you say, now I want to quickly get in, and benefit on this bull run, a bear run comes. And what happens? You start seeing the prices go down, and then you start saying, no, the stock exchange is not good. The stock exchange, I lost my money. I lost this. But if you are patient with your capital, when you enter the stock exchange, you will not lose out. So that is the story around the stock exchange. We must be patient with our capital. Let's put our money, and let's not be in a rush to take it out. Now, the question that someone asked me to say, how do I choose? How do I pick a stock to buy on the stock exchange? My answer to that is, I cannot in this platform give you to say go and buy Old Mutual, or go and buy PPC or Econet or this stock or that counter or whatever. But what I can say is, when you are ready to invest on the stock exchange, there are platforms that are available. There are stockbrokers. For us to buy a share on the stock exchange, we use stockbrokers. And these stockbrokers are the people that will give us advice. You may invest, for example, there's a top 10. You can go there and say, I want to invest my money in equal distribution in the top 10 shares. They will then show you to say the top 10 shares that have been performing well for the past 5 years are A, B, C, D. And this is the return that you are likely to get, because this is how they've been how they've been moving over the past 5 years, or whatever number of years that the statistics that they have. So your stockbroker is there to help you in choosing or in picking counters that you can buy. So we must be able to use those stockbrokers because they will assist us. But there's also another platform called C-Trade, and it's also available. It's an app actually, and it's available for us. It's available for everyone. You can download it on your phone, and once you download it, you can transfer money from your bank, you can buy your shares, you pick a stockbroker, and then you can do all this transaction from the comfort of your phone, and you can actually see the performance of your shares once they go up, once they go down. But one thing that I can guarantee you is the stock exchange at the moment is one of the best ways of saving money in Zimbabwe. Then, moving on from the stock exchange, there's another platform called unit trusts. So we've spoken about stock exchange. The second issue, the second platform that we can use to save our money is called unit trust. Unit trusts are also available for us, and there are different types of unit trusts. There is a property there's a property fund, there is a equity fund, and they have also shown us that they also perform better than inflation. So if you put your money in your unit trust, you're likely to get a better return than what you get from just keeping your money in your pillow or buying forex, because we think that buying forex is actually an investment, and I'm trying to tell you that buying forex and keeping forex in your pillow is actually not an investment. You're actually losing. And the other time we were talking about the losses that you get from just buying forex. If when you buy forex, you get the Mtuli tax, you will also be charged a higher rate. When you want to sell your forex, you get a lower rate, and when you are spending your money again, you get the 2% tax again on your money and bank charges on top of that. So you buying forex and keeping your money in forex and then exchanging back to Zim dollar and all that, trying to save your money is not it. It's actually not saving, it's actually just keeping money for tomorrow's use, and that money is available anytime. I've seen it myself. I normally steal from myself. If I put some money aside, after a few days I'm broke, I'll just say, let me borrow from that fund. I'll return the money. And normally I'll see my fund going down all the time. Why? Because it's available. But when you're investing your money in unit trusts, stock exchange, it's not as easy as that. It's easy, yes, to get your money out of the stock exchange or out of unit trusts. Maybe 2-3 days, your money is ready. but definitely that money is not available for transactional purposes. You can't go to your stock exchange and sell shares for you to go and put fuel in your car, or you can't go and sell shares to give your friend $100 because they want to do something that they are trying to borrow money from you. So it's safe. So on top of it being safe, it also avoids us spending money uselessly or in a reckless manner. So talking about unit trust, I said in unit trust there are unit trusts that are linked to the stock exchange. So if you are not really comfortable with going in to pick certain stocks, you can go to unit trusts, CBZ, Old Mutual, KEBS, they all have unit trusts. So you go there and you pick stock exchange linked, equity, they call them equity linked. And this, they track the all share index movement, which is as good as you have invested in the stock exchange. And then, especially for Old Mutual, they've got another one that they call the property fund. This property fund, it tracks the rentals that especially for Old Mutual, that they are getting from their properties. And you know that Old Mutual is one of the biggest property owners in this market. And so what they've done is they've taken their properties, they get rentals, they get this, and the movement that is happening in those rentals. So your investment in the property fund is linked to the income, is linked to that movement. And property market in general has also been outperforming inflation or tracking inflation. It's better that it's tracking inflation. It may be slightly above, but it's better than just keeping your money as it is. So I think for today, those are the two issues that I wanted to discuss. The stock market, just a bit more clarification, in the unit trust. Keep the feedback coming in. We have got more issues that we are going to discuss about around this topic of saving, around this topic of investment. We've got other platforms that we're bringing in, and what we are just simply trying to do is to change our mindset so that we can then start saving and change our behavior from a transactional behavior into a saving behavior. And the saving behavior is good for you, it's good for the economy, and it's good for the future of our kids. One person was telling me, it's actually a movie, which said we owe it to the dead to live a better future for our kids. And I believe that. Thank you for today. Hey guys, one more thing. Remember to like, to share, to comment, and to subscribe. Let's continue the discussion. Let's continue the interaction. Thank you.